Hi everyone, it's Grace. Welcome back to my channel. So for this semester, it's absolutely crazy with all the calculations and also what's going on in the real world. So I learned quite a lot about the discounted cash flow model, about the bonds and stock valuations and stuff like that. I mean, there's a lot of calculations, but I really had a lot of fun. So for today's video, I'm actually going to share with you my take on why SVB collapsed. Alright, so before we begin today's video, remember to subscribe to my channel and click on the bell button so you get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. Alright, so please also consider support my channel by donating any amount that you feel comfortable with, either through PayPal, Cash App, Zelle, or QuickPay. And I'll provide the links in the link tree in the description down below. Thank you so much for your support. Also, please remember to subscribe to my TikTok account as well. So I think there is no coincidence that SVB is the one that collapsed. After all, it's the first bank that ever collapsed since the 2008 financial crisis. But I do think that there's a major difference. So back in 2008, we all know that it's the subprime mortgage crisis, right? And right now, what I'm seeing is actually bond crisis. And it has a lot to do with the Federal Reserve basically raising rates in a matter of like 12 months from near zero to 4.58%. So as you can see, this significant increase and sudden increase of the Fed funds rate and essentially the treasury yield is creating a lot of systematic risk in the system. All right, so SVB is actually, if you don't know the background of it, it's basically a bank for technology companies and for venture capitalists, right? And just to give you a little bit of the backdrop, it's actually going pretty well. A lot of people, especially for venture capitalists, they deposit their money into the bank. However, there is a big problem. If you know the technical sector, the technology sector is actually having a lot of turmoil since before the pandemic begins, right? So it's going up the sky, and then it's over hiring, its valuation is just going through the roof. And then as soon as the Fed starts to raising rates, it's like been off the cliff. Like we're seeing that the tech layoff is taking place, and also there's a lot of like funds are actually being dried up in the sector as well. All right, so the first thing that I want to show you is the 10-year treasury yield. So this is one of the most important graphics that you should look at for today's video. All right, so as you can see, the yield is actually going up quite a bit, and this has to do with the Fed funds rate being raised quite a lot as well. So this is the long-term yield. Actually, a lot of institutions are holding, and for SVB, it also holds a lot of this yield. All right, so we're going to see the second graphic here. So on the balance sheet for SVB, there are two types of securities. The first one is held to maturity, and the other one is available for sale. But if you're looking at these two types of securities, it's fluctuating up and down a little bit, actually according to the reversed relationship of the treasury yield. So basically, when the treasury yield is going down, its bond price is going up. When the yield is going up, then the price is going down. But the funny thing is that, you know, SVB actually holds a lot of these long-term yield. And why is that the case? So basically, just like in any other financial institutions, SVB also has to make money. So one way that it makes money is to promise the depositors with essentially an average of 0.2%. It's not a lot, but compared to a lot of other banks, it is decent, right? But in order to give that return to the depositors, it also needs to make money and also maintain a healthy profit margin. So it's investing a lot of money into these long-term securities to get an average of 2%. So it's making a profit margin of 1.8% essentially. So one of these problems with these long-term security is that its price fluctuates quite a bit. If it's not selling them, then it's fine, right? If it's maintaining a lot of liquidity, then it doesn't have to sell, even if its price is dropping quite a bit. But it's meeting a lot of problems with liquidity, meaning that it doesn't hold enough reserves. It's just risk level is too high compared to other banks. And also it doesn't have all the depositors insured. So that's one of the risks there. And the second risk is related to the treasury yield. So as you can see in this graphic, so both the held to maturity securities and available for sale to maturities actually dropped quite a bit in terms of its price. So just a little bit over 2 weeks ago, it announced that it made a loss of $1.8 billion when selling one of these long-term securities. So as you can imagine, a lot of the depositors for SVB are actually very financially mature depositors, right? They have a lot more information and also knowledge about what's going on in the tech sector and also venture capital. So they really don't trust that much. And also the portfolio companies of these startups are saying, just get out before everything explodes. And it did. So that's why there is a huge bank run. So for SVB, I do think that its risk management is not as well as done as the others. All right. So that's essentially what's happening with SVB. And then besides that, we also are seeing a lot of banks such as Credit Suisse, which you have seen over the weekend, and also First Republic Bank. So First Republic Bank is the other one that's having a liquidity crunch, but the other big banks are actually coming in to deposit $30 billion just to maintain that safety haven. All right. So that's pretty much what's happening so far. And I do want you to remember that Silicon Valley Bank is actually very heavily related to the tech sector, and it has this specific situation. So we should not generalize to the other sectors as well. But for the future events, I'm going to keep an eye on it. And thank you so much for you guys for watching today's video, and I'll see you on the next one.